Most of the trading advice you see online is incorrect. You hear advice like use this compounding strategy, use the martingale strategy, use a 1 to 2000 risk to reward ratio, or use a 1 to 2000 leverage, and you think to yourself, how am I supposed to navigate this complicated advice and complicated FX market? Now, throw all that crap out, because I am going to show you how you can really grow a small account using the proper steps. Now, in these steps, in the next steps that we're going to look at, you are going to learn how you can safely grow small account into a relatively larger one. So be sure to follow all of the steps that we're going to look at and don't skip at any one moment. So the first step that you need to take is you need to choose the right broker. Okay, you need to choose the right broker that offers high leverage, so that you can take advantage of the leverage that is available for you to be able to use a higher buying power or higher purchasing power when you are taking your trades. For example, when you have a $100 account and you are trading with a 1 to 50 leverage, that will limit your buying power. Okay, but when you are trading with a leverage of 1 to 1000, it will multiply your account balance by 1000. For example, if you have $100 on your account, then it will be able to multiply by the leverage your account balance, so that you have a purchasing power of $100,000. That means you'll be able to take up to a standard lot size on a $100 account. That is the beauty of leverage. You can potentially win more money or earn more money when you use a higher leverage. What this means is that you can risk more money in order for you to earn more money just by picking a higher leverage. However, you should know that leverage is a double-edged sword. Leverage can help you to grow your account very fast, because you can be able to take higher lot sizes on the account, but it can also be detrimental, because it can cause you to either blow your account or completely ruin it. Okay, completely ruin it, because you may end up losing much more or much faster than what you would lose if you are using a lower leverage. Okay, so when you have chosen the right broker, make sure you do your research. I don't want to go and start recommending brokers here and there, though I have two specific brokers that I use. You can check the link in the description. There are two specific brokers that I have been using for quite some time, and I've not had any issues with them. So you can check the links in the description and sign up with them, so that you can be able to take advantage of the leverage, so that you can trade for more profits. The second step is that you need to take only high probability setups whenever you trade. Okay, don't just randomly take trades. Only take the risks that are worth taking. Okay, take only high probability trades. Some of you have been asking me how I am able to get a 70% win rate on the signals that I'm sending on Telegram, like the swing trades I'm always sending on Telegram. You ask me how I get the 70% win rate, but it's just because I look for high probability trade setups. I don't trade every single day or send signals every single day, but whenever I send the signals, they have at least a 70% win rate. So only look for high probability trades when you are trying to grow your small account. Doing that will help you to multiply your money very fast. Now, talking of that, when I had just started trading, like a year into trading, I remember I placed some trades onto my account, and then I even forgot about that. Okay, because by that time I was still doing a 9 to 5. So when I did place those trades, I even forgot about them. Coming back later, I saw, as you can see on the screen recording on the screenshots here, I was able to take an account from like 94,000 Ugandan shillings to over 2-point-something million. But that was just like a beginner's luck. Okay, it's not always happening like that. But what I learned from that is that you need to follow the trend, because when I went and looked at those trades and saw how they moved, I actually did enter the trades on the correct trend, and the trend continued to move in the direction that I had actually placed the trades in. So before you enter the trade, look for a high probability setup and then follow these steps. First, you need to establish whether the market is trending in a bullish trend or a bearish trend. Before you buy, make sure the market is moving in a bullish trend. Don't just jump onto the market just because you've seen the market producing a green candle. Make sure you see the overall picture, whether the market is in a bullish trend or not. Because if you don't check the trend of the market, the current trend of the market, either using top-down analysis from the monthly chart coming down to your entry time frame, if you don't check that, then you'll be trading against the trend, and you most likely will end up losing that trade. Okay, so make sure you check the trend first, and then you need to look for specific entry triggers. Okay, that can be within your specific strategy that you trade, or you can have other confluences attached to whatever strategy that you're trading based on your risk management. Okay, I have a strategy that I'll link at the end of this video. You guys will be able to see the strategy that you can follow. It has up to 60% win rate, so you can follow that strategy and use it to trade or grow your small account. So make sure you look for the entry triggers, and those entry triggers can be areas of support or resistance, supply or demand, order blocks, whatever you want to do according to your strategy. Okay, so follow that as you are entering your trades. The third thing is you need to choose where you put your stop loss and you take profits correctly. Usually, take profit and stop losses are set based on your risk per trade, depending on whether you're risking 1% or 2%. But we'll talk about the risk as we progress ahead. Okay, and the other thing is, don't try to trade all the setups that you see. Sometimes you might see a high probability setup or a medium probability setup or a low probability setup, and then you find this voice convincing in your head that, okay, let's take this trade, take advantage of this trade. But if you learn to control your emotions when it comes to trading and avoid certain trades, even if you see the trade might go in your favor, you just let it go, just because you don't have to trade every day or take every setup. That will help you develop the muscle of patience within you, so that you can be able to withstand those voices in your head that tell you to overtrade. Because if you don't stop over trading, you will not be able to grow a small account. You will end up losing it, because over trading causes you to lose many trades, because you'll make mistakes and sometimes even deviate from your trading plan. So don't trade each and every setup. Just choose the setup according to how you are planning to grow the account. Okay, the third step is slowly increase on your risk or increase on your lot size as your account grows. Okay, if you started from say $100 and then your account grows to like $500, if you started while you are risking say 0.1 lot, or you're risking a micro lot, by the time you reach $500 you can start risking like a 0.05 or 0.06 as you grow. It's just like when you go into a gym and you're starting to train, okay, to try to grow your muscles. Okay, the first 1, 2, 3 days, even a week, you may not see a change, but as you persist, the dumbbells that you started with become lighter and lighter, so you need to increase on the repetitions or the weight of the dumbbell to compensate for how you are getting used to it. So it's the same thing. As your account is growing, for it to grow faster, you need to increase on your risk per trade. Okay, the lot size that you're risking per trade. Your risk may stay the same, like 2%, 3%, but your lot size has to increase in order for you to grow faster. And you also realize that if you continue thinking of risking only 1%, 2%, guys, it may take you forever. It may take you years for you to ever see, for example, a small account of $100 growing up to $15,000, $20,000. It may take you years if you're risking 1%, 2%. What you need to do is you need to exponentially increase on your risks depending on your risk appetite. Like for me, sometimes if I want to grow a small account, I can risk up to 10% of the account, because I'm comfortable losing that. For example, on $1,000, I can risk $100 in order to get like $200. Okay, so your risk appetite is what drives the growth of your account. If your risk appetite is very low, then you may not grow the account that fast. It may take you many years for you to realize any growth. Okay, you should increase on your risk or on the lot size that you're trading according to how your account is growing, so that you can exponentially grow. But I am not telling you to go and risk 50% of your account. Okay, be sensible enough not to think that you now, because Matthew has said you should risk, then now you go and risk 50% of your account. That will be detrimental to your account, and just 2 trades can blow your account if you risk 50%. Okay, so be realistic and risk what is necessary for you to grow faster, but not enough to blow your account in 2 or 3 trades. Okay, 10% can be cool if you want to grow your account much faster. Okay, the 4th step is compounding your account. Whenever you go to social media, Instagram, TikTok, YouTube, you find people telling you about compound interest. Sometimes if you look at compound interest in finance or economics, you see that compound interest is what the institutions or banks or other hedge funds and what used to grow clients' money over a long period of time. Okay, for example, if you invest $100 in a stock, I'm not telling you to go invest in a stock, but I just giving you an example. If you invest $100 on a stock with a 20% return per year, in 30 years you will have $23,000 sitting on your account. But the question is, who among you guys who's watching this is willing to wait for 30 years to accumulate $100 into $23,000? I don't think any of you guys will be patient. Me, I wouldn't be that patient. So you should take the matters into your own hands and start to compound on your own. How do you do this? Do this by increasing on your account size. Keep on depositing the money that you need to trade so that you can trade a larger lot size for you to grow your account bigger every single month. So take compounding into the equation and add it into your trading plan so that you can be able to grow exponentially. Talking of compounding doesn't mean that when you're compounding, you're not supposed to withdraw. You can withdraw your money, but do not withdraw more than 50% of the profit that you've made the previous month. Okay, just try to withdraw less than 50% of the profit that you've made in the past or that you've made the previous month. In that way, you will allow your accounts to grow linearly or in an exponential way for you to be able to see it grow faster. So use compounding interest, but also be wise while you're withdrawing. Don't over withdraw money from it. Let the account grow. Now, in telling you about depositing or adding money onto your account, don't be dumb enough for you to say, okay, now let me go withdraw all of my life savings and then put it all into the account. That would be the dumbest decision you would ever make. Okay, just deposit what you're willing to lose, that even if you place a trade and you lost, you can be able to sleep at night comfortably without thinking about it much. Okay, don't be unwise, just be wise while you're doing this. Deposit what you're willing to lose, guys. Fifth thing is, do not try to think about your profits in terms of money, okay, in monetary terms. All right, don't look at it in terms of, say, $30, $50, $100, because when you do that, if you end up winning, for example, you place a trade and you win $500, you'll be so excited because you will see the $500 in terms of the cash. Okay, but what I want you to do is, don't look at it in a monetary way. Look at it in a percentage way. As you're growing, look at your growth in a percentage way. Okay, because if you look at it in a percentage way, the losses and the profits won't affect you that much, because you will be looking at everything in a percentage. For example, if you lose 10% of 1,000, it will be $100. But if you're looking at it in terms of money and you see, oh, I lost $100, oh, lost $100, that will be more painful if you're looking at it monetarily. All right, so look at it in terms of percentage. That will help you to have peace of mind as you're trading. The other thing is, make sure as you're trading not to look at the small account as the way for you to be able to make a living. I've seen many people thinking of making a living out of $100 and all that. For a start, yes, that is possible. But as you go on, you need to scale your capital. You need to find a way of increasing that capital, because if, for example, you're risking $50 or $500, that's 10%. It will make you, yes, $100. Let's say a trade, if you get a 1 to 2 risk reward ratio. If you want to take this to another level and you want to take it to a higher level where you're getting more profitability, you can't do that with a small account, guys. You cannot do that with a small account. You need something substantially big. That is why we need prop firms. Now, I know there's a lot of controversy going on with prop firms, but you need prop firms in order for you to scale your capital. Now, you can only get into prop firms if the strategy that you're using is profitable and you have an edge in the market. Okay, you have a profitable edge. If you have a trading strategy that allows you to win up to 40% of the time. By the way, I will leave a link of that at the end of the video. You can go check out a strategy which has at least 60% win rate. If you have a strategy, then you can take advantage of prop firms. You can invest as little as, say, $100 for you to get a 25K account, okay, which you can then use to trade. And if you pass the prop firm, for example, if you go through the challenges and you pass, then you get funded, that will be the beginning of a change in your life. Because when you make just 2 to 3% of that money, it will be way better than you trading a $500 account on your own. Okay, so take advantage of the prop firms for you to be able to grow your small account into relatively big account. Now, talking of that, if you take an example, for example, if you get a 100K account and you are able to pass it and get funded, just 1% a month is enough for you to be okay, because that will be $1,000 every single month, which is way better than for you struggling. Just by getting 1%, you get $1,000. So guys, with that, I leave you with this next video. You guys go watch it. It will help you to be able to get a profitable edge in the market. Till next time.